from 2018 up until the beginning, or not really the beginning of this year, but probably Q4 of last year, you could have calculated an incredibly tight correlation between the stock market and the Fed money printer. So the Fed is in control of how they can introduce dollars into the economy. How do they do that? They literally manifest money. They don't actually technically print it, but let's just assume for these purposes that they actually do print it. And they literally take that money and they enter the market and they buy things with it. And they're giving you this newly created money that they just created out of thin air. From 2018 up until about Q4 of last year, there was a 0.92 correlation between that and the S&P 500 going up. What does that mean? So if you look at a -1 correlation, that means that if something goes up, this thing goes down, dollar for dollar, that would be perfectly negatively correlated. If you look at something that has a 0 correlation, that means it's just random. Whether one thing goes up and down has no influence on the other. But a 0.92% correlation effectively means that for every dollar the Fed created, the stock market was going up by that same dollar. And that is literally what we had up until November of 2021. Since the beginning of this year till about yesterday, so I think the number is still going up, probably by at least by $1 trillion, we have destroyed collectively as a society $35 trillion in global market value. Now, to give you a sense of that, that's 14% of all global wealth that has been destroyed in basically 5 months. And for reference, in 2008, when we went through, a cataclysmic shock to the system that threatened the banking infrastructure of America and a potential contagion to the world, that destroyed 19% of the world's global wealth at that point. So, we're approaching some really crazy, heady moments in time where, in terms of the market correction and the value destruction. The difference here is that the last time around, it was really about a handful of financial institutions and some very specific assets, right? Mortgage-backed securities, some parts of the credit market, and then a bunch of financial stocks. And that was largely it. This time around, as you just said, Freeberg, it's literally everything that's getting smoked. There is not a place that you can effectively hide that has been safe. Crypto, smoked. The credit markets, totally frozen. The equity markets, NASDAQ is in a bear market. The S&P is basically flirting with the bear market now. And I don't really see any end in sight. Meanwhile, we're waiting for CPI to downtick. Inflation hasn't really done that. It looks like
Consumer Price Index, how much stuff cost.
So that's taking a lot longer than we thought to sort of roll over. Separately, jobless claims are now starting to tick up, which means that companies are beginning to effect layoffs because they feel this pressure. So now you're going to see an unemployment rate that starts to go up. And then meanwhile, we're fighting a proxy war in the Ukraine against Russia to the tune of about, $40 billion every sort of month or so when we open the paper and decide to read about it. So you put all these things together, it's not clear that there is the momentum to create a market bottom.
Real estate, Chamath, if you look at it, was a major compression in 2008. Real estate is holding up, seems to be holding up a little bit. I don't know how that long that's going to last with mortgages going up. So when you were talking about all the different categories, I was like, that's the one category that I guess hasn't fallen yet. Sachs, what's your take on all this?
Yeah, I mean, look, we're in a stock market crash that I think over the last week sort of became a panic. I mean, I think now there's panic selling going on. That's not to say that it's all oversold, but certainly there are names now that are starting to become screaming buys. But nobody has the capital to buy. I mean, it's easy to say, in theory, that you should be greedy when others are fearful and fearful when others are greedy. The problem is that everyone's already fully deployed. And then when the stock market crashes, they got no cash left to buy up new names. And that's one of the things that you've noticed in this downturn. And I'd say, especially with crypto, is with all the other crypto downturns, there were always, the crypto accounts saying hodl or buy the dip or, they had the laser eyes going. I don't see any of that right now.
Pure capitulation, fear.
Exactly. Yeah, exactly. So this is just a rout across the board. I agree. It's every asset class. I think home prices, that's coming, Jason, because like you said, mortgages are going up.
Inventory is going up. So that's a leading indicator. Yeah.
People can't afford the same mortgage they did before because rates are going up very fast. So, sellers are going to have to drop prices. And until they're willing to do that, the inventories go up.
That's a little dance that happens in real estate is the sellers don't want to accept reality and they don't have to sell because they're living in it, as opposed to their crypto holdings, which they're not living in and they're not getting value from.
And frankly, I think the consumer in general, that's the next shoe to drop here, because right now you had this sort of financial correction, you had this massive asset inflation, and now that the air has come out of the balloon, but the consumer has generally been holding up pretty well. Obviously, we had unemployment, near 3%, very low, although the labor participation wasn't great, but the consumer was doing fine. It was sort of holding up the economy. Now I think you've got a bunch of different factors that are going to really hurt the consumer over the next several months. Like you said, interest rates going up means that home loans become more expensive, car loans, any other, personal consumption loans go up. Credit card debt now has all of a sudden skyrocketed. So there's an article in Axios on this, that the amount of consumer debt is surging and to this highest level of increase in over a decade. So consumers are turning to plastic to cover the soaring cost of everything. And then because of inflation, that wages in real terms fell 2.6% over the past year. So in other words,
because of inflation, when you say
because of inflation. So if you're to look at wages in real terms, people are actually making less money.
You give somebody a 10% raise, 8% inflation, it nets out to 2.
Well, no, you're giving them a 6% raise.
Oh, I'm sorry.
Or like a 5.6% raise or something like that against 8% inflation. And net, they're down 2.6%.
Got it. They're down 2, not up. Yeah.
In purchasing power.
Exactly.
In spending power. Sachs's point is the number was 60 billion of new consumer credit last month, which is like something we haven't seen in a very long time as consumers try and bridge this gap to afford the things that they've gotten used to spending money on. To jump up like that just indicates that we may be in the beginning of a consumer credit bubble now, which is scary.
Right. This is the question: is what are the next shoes to drop? So you think about like what's happened in the market so far. It's mainly been multiple compression. Like earnings season was pretty good. I mean, it was hit or miss.
Amazing for some folks. Yeah.
For some folks. So the stocks that got hammered were generally the COVID stocks. It was the Pelotons, the Netflix, Zoom. You could like Coinbase and Robinhood with the day traders because that was people are laying off that stuff. So basically the COVID stocks have been hammered, but the B2B stocks actually had really good results. And yet, the SaaS index is down like 80%. The average SaaS multiple, it was over 15 times, last year on the public comps, and now it's down to 5.6. So the SaaS companies have been hammered despite having great earnings. So what we don't know now, they're B2B. They're a little bit insulated from the consumer. But what we don't know is what happens over the next 6 months. If we go into a deep recession, then do even the B2B companies start being impacted?
That would look like, Sachs, just to be clear, people maybe start canceling their Netflix or they don't take that vacation. That's the consumer getting hit first. A business that's laying off 10 or 25% of their employees, which we're starting to see that contagion, they might also pull out their SaaS bill and say, here's 12 SaaS products we're playing for. Let's consolidate down to 8.
Right. I've got a SaaS startup that sells, 6 and 7 figure deals into enterprises. And they closed their deal with Uber the day before Dara's memo came out saying we got to be really focused on cost cutting. What Wall Street wants now is free cash flow.
Yep.
We got to really sharpen our pencils. They were like, shoot, good thing we got this across the finish line. Yeah. If it had been like 2 days later, it just would have been a much tougher process. So first, you're right. The companies that get impacted are the ones with exposure to the consumer, but then those companies start sharpening their pencils and buying less. So the question is, how much are earnings now going to be impacted in the B2B space? And what sort of recession do we have? I think like recession now is just inevitable. To Chamath's point, you can't have 14% of global wealth wiped out practically overnight and not have that translate into a big recession.